Hello everyone. On this week's episode of Nestology TV, we will discuss the potential government shutdown and how this could impact investors and the economy. Let's get into it. The term government shutdown has undoubtedly become familiar to investors in 2018. Headlines may prove more unnerving than reality, though. But recent volatility has shown that investors are nervous following the relentless rise of the bull market and are on the lookout for any catalyst that could move the markets lower. Politics can affect sentiment, and investors must be prepared for this possibility. Government shutdowns are events that mark the closure of non-essential offices of the United States government due to lack of congressionally approved funding and have the potential to increase risk and temporarily weigh on investor sentiment. Although these events can be worrisome, we encourage investors to view shutdowns through the prism of history and consider both the long and short-term impacts. To that end, we look to key financial market indicators such as solid fundamentals, supporting growth in economic activity and corporate profits, while appreciating the limited impact that government shutdowns have historically had on the economy and the broader markets. So, how do shutdowns impact the economy? Government shutdowns have rarely caused economic dislocations. In fact, there have been 5 recessions over the past 42 years in the United States, and the government shutdown has never been the catalyst. The government shutdowns in 1981 and in 1990 occurred when the economy was already in recession, and the 1982 occurrence took place just as the U.S. economy was just emerging from recession. Many factors, including overall economic growth, inflation, and Fed policy, impact bond returns. History has shown that the government shutdowns typically do not have longer-term impact on U.S. Treasury markets. In fact, the total calendar year return for the Treasury Index has averaged 9.5% in shutdown years, though we do understand this occurred during the 35-year bull market run with bonds, and we wouldn't expect similar performance going forward. The 19 government shutdowns since 1976 have proven to be non-events for the stock market, including the most recent event in 2018. The S&P 500 index on average lost just 0.5% during periods of closure, and previously gone on to return an average of 12.3% in the 12 months following the start of the shutdown. In a sign that investors may have become desensitized to these events, the S&P 500 saw annual double-digit returns during the 3 government shutdowns prior to January of 2018. Investors should keep in mind that the government shutdowns, though high in drama, rarely provide lows in economic or financial market activity. We remain hopeful that our elected officials will reach an agreement to avoid another shutdown. But even if they do not, we would encourage investors to look past short-term headlines and focus on the long-term fundamentals that have historically driven our markets. As always, we want to thank you for joining us this week on Nestology TV, and whether or not the government shuts down next week, we will see you here next week.